Welcome back to Investing Talk Podcast.
Today we are looking at a company that might just be the most fascinating and arguably the most terrifying turnaround story of early 2026. We're talking about Nuburu, ticker BURU.
I've got the chart open, and I've got the financials open, and I have to be honest, right out of the gate, this looks like a crime scene.
A crime scene.
I'm seeing a stock chart that's down, 60%, financials that are just bleeding red ink, and a market cap that's barely a blip. Before I start tearing this apart, what's the actual mission here? Why are we dedicating time to a stock trading under 20 cents?
Because looking at the past 12 months, this chart is like looking at a chrysalis and complaining that it doesn't fly.
Okay.
The headline is simple. You are looking at a stock trading for literal pennies that claims to have just solved its single biggest existential crisis.
Revenue.
A big claim. We are watching a company attempt to transition in real time from a cash-burning science experiment into a vertically integrated global defense contractor.
Whoa, okay. That's a massive claim. So you're saying this isn't just a penny stock story. It's a defense restructuring play.
Exactly. The data fundamentally changed this week. This isn't just a story about lasers anymore. It's about a new acquisition, a defense pact, and a financing deal that changes the whole picture.
All right, that's a heavy hook. As usual, before we start, subscribe, like, and comment to this video to support the show. We really appreciate it. Now, let's get into the weeds. You said the data changed this week, but when I look at the trailing 12 months, I see a complete disaster.
Well, in the world of microcap turnarounds, the trailing 12 months is a history book, not a roadmap. Today, January 20th, 2026, marks the completion of the Lyocon acquisition. That singular event, it renders the old numbers obsolete.
Okay, let's pause and unpack the old numbers first, just so we have a baseline for how deep this hole is. I'm looking at revenue for the last year, and it says $9.3 thousand. Not millions. Thousands. That is basically a lemonade stand.
It was effectively zero commercial revenue. It was purely an R&D shop. They were developing the tech, not selling it.
And to generate that $9,000, they managed to lose $55.76 million. The EPS is negative 13 cents. I mean, if I'm an investor looking at a spreadsheet, this is a money pit. It's a black hole.
And if you only look at the spreadsheet from yesterday, you're right to walk away.
Yeah.
But the Lyocon acquisition changes the fundamental nature of the business.
Wow.
Nuburu is no longer just a research lab with some patents. Lyocon is an established Italian laser engineering firm. They have a factory. They have existing customers. They have recurring revenue streams.
So wait, they realized they couldn't sell their own tech, so they just went out and bought a business that already knew how to?
That's a cynical way to put it, but yes.
Yeah.
They bought an asset-backed operational platform. This instantly puts them in the $20 billion global industrial laser market. They now own the factory.
Okay, so they bought a lifeline. But buying a company requires capital. You mentioned defense strategy, too. Is this just a press release to pump the stock, or is there real substance?
This is where it gets really interesting. They've partnered with Tecne, a significant Italian defense firm. And I want to be clear about the term here. It's not a memorandum of understanding or some strategic intent.
Right, not just a handshake.
No, it's a formal network contract.
Network contract sounds like legal jargon. Translate that for us.
In European corporate law, it's a binding alliance. It lets them bid on contracts together as a single entity. It covers APAC, NATO countries, the Middle East, North Africa, and the Americas. Revenue is expected to start hitting the books this fiscal year, 2026.
So they're piggybacking on Tecne's relationships to get their lasers into military hands?
It's broader. They're building a defense and security hub. Think of it as a whole ecosystem.
Okay.
Hardware Nuburu's lasers on mobility platforms from Tecne. But here's the kicker. Nuburu issued a 13 million euro convertible loan to Tecne.
A convertible loan. So a path to ownership. Why is a tiny U.S. company lending money to an Italian defense firm?
To take control. The loan can convert to equity. They are positioning themselves to potentially take a controlling interest in Tecne.
That is an aggressive move for a company with this kind of financial history. It feels like a minnow trying to swallow a base.
It is aggressive. And on top of that, they've increased their stake in a company called Orbit, which does software for crisis management.
So you've got the laser hardware, the vehicle it sits on, and the software that runs the operation.
Precisely. A full-stack defense play.
It sounds incredibly ambitious, maybe too ambitious, but I have to ask about the core tech. What is this blue laser technology, and why is it worth all this trouble?
This is the moat. This is why anyone cared in the first place. Most industrial lasers are infrared. Great for steel. But try to use infrared on copper, gold, or aluminum.
It just reflects the beam, right?
Exactly. The energy just bounces off. It's like trying to heat up a mirror with a flashlight. You have to crank the power, you get warping, spatter. It's a mess.
And copper and aluminum are the holy grail right now. EVs, batteries, electronics.
You nailed it. Nuburu's blue laser operates at a different wavelength that is absorbed much more efficiently by those metals. It welds faster, cleaner, higher quality. It is a superior mousetrap for the electrification age.
So the tech is solid. The problem was they couldn't sell it at scale.
Great science, terrible business model. Until now.
Which brings us back to the cash. How are they paying for all this? The acquisition, the loan to Techne?
They secured $23.5 million in financing on January 10th.
Okay.
It came via debentures and warrants.
So for the listener, break down debentures and warrants.
A debenture is basically a loan backed by the company's credit, not physical assets. Warrants are like sweeteners. They give the investor the right to buy stock at a certain price later. It's how you entice investors on a risky bet.
So they took on debt, but they got the cash. $23 million is a big deal for a company this size.
It funds the whole integration of Lyocon. It bridges the gap from the money pit you described to the revenue-generating company they're trying to become.
All right, they have cash for the immediate future. Let's pivot to the charts, because the price action tells its own story, and frankly, it looks like a roller coaster that derailed.
Weil doesn't even begin to cover it.
The stock is currently trading around, what, 17, 18 cents? It's down over 4% today and nearly 60% over the last year. This is what we call a falling knife.
Historically, yes. If you tried to catch this 6 months ago, you lost fingers.
And the volatility is extreme. 52-week range is from 12 cents to 85 cents. If you bought at the top, you've been crushed. Why would anyone see opportunity here and not a graveyard?
Because you have to look at the setup right now. A breakout narrative is forming. Look at the news flow just in the last 7 days. Financing, partnership, acquisition. The market is just starting to digest that this isn't the same company it was 2 weeks ago.
I'm looking at the floor. It seems to be basing around that 12-cent low.
Right. That's your support. But look at the upside. If this thesis holds, and the stock just retests its 52-week high of 85 cents, that is a 380% move from here.
That's some serious leverage. But what's the volume telling us?
It's spiking. The 3-month average is around 49 million, but we're seeing bursts of 27 million. The float is high, over 130 million shares.
A high float usually makes it harder to move the price up. Too much supply.
True, but at this price point, it's a playground for momentum traders. If sentiment shifts, that float can turn over very, very quickly.
Moving on to market sentiment. With a stock down this much, you'd expect doom and gloom. What's the feeling out there?
Surprisingly, the quantitative scoring on the news sentiment is strongly bullish.
Put a number on it. How do you measure that?
We take a weighted average of the last 5 major articles. The score comes out to 0.447. That's a bullish consensus.
That's high for a penny stock.
It's the headlines. Nuburu stock rises on strategic execution milestones. Inside Nuburu's $20 billion blue laser bet. The media and the algorithms are treating this as material.
That's interesting because usually with penny stock financing, the algos just read dilution and sell.
I think the market sees the Lyocon and Techne deals as lifelines. They're raising money to buy revenue, not just to keep the lights on. There's a difference.
And we have to circle back to that $23 million raise. Institutional money wrote that check. You don't put that kind of money into a company valued at $55 million unless you see a clear path.
Exactly. It validates the thesis at this valuation.
What about the speculative catalysts? What else could send this higher? Because these stocks don't go to $1 on slow growth. They go on hype.
The biggest one is control of Techne. If they convert that loan and actually acquire a controlling interest in an Italian defense firm, they become a major defense platform overnight. That changes the multiple completely.
Explain that, the multiple change.
Defense contractors trade at steady, reliable multiples. Tech labs trade on hopes and dreams. If they become a real contractor, the market values every dollar of revenue much, much higher.
And the software side with Orbit?
Right. SaaS revenue scales beautifully. If they can sell high-margin crisis management software with the hardware, the whole valuation re-rates again.
It sounds great. It really does. But let's look at the risks, because I'm still stuck on a few things that just don't add up. I have to play the skeptic here.
I expect nothing less.
Okay. Risk number 1, execution versus team size. I did some digging. Based on available data, they list 8 employees. 8.
It's an incredibly lean team.
Lean is an understatement. How can 8 people integrate an Italian manufacturer, manage a global defense partnership, and run a SaaS platform? It sounds like a recipe for disaster.
That is a fair point. It's the biggest operational risk. However, you have to remember, Lyocon comes with its own team. They bought the people who are already doing it.
But managing a team in Italy from the U.S., time zones, language barriers, with 8 people, if one person gets sick, the whole thing could grind to a halt.
It's a bottleneck risk, absolutely.
Right.
They will need to hire or rely heavily on the local management teams.
Which brings me to risk number 2, burn rate. They lost $55 million last year. They raised $23 million.
Correct.
The math here is simple. If they burn cash at the same rate, that $23 million is gone in less than 6 months. They'll have to raise money again, and that means dilution.
That is the race they are running. The bull case is that the $55 million was heavy R&D spend. Now that they're operational, that spend drops, and Lyocon's revenue offsets the overhead. But you're right, it's a race against time.
And risk 3, government red tape. Defense contracts move at a glacial pace. A network contract sounds fancy, but getting paid by a government can take years. Can they survive a 6 to 12-month delay on that revenue?
That is the biggest external risk. But again, that's why the Lyocon piece is so critical. Lyocon serves industrial customers who pay their bills on time. Lyocon is the bridge that gets them to the defense payday.
So the whole thesis relies on the Italian factory keeping the lights on.
Essentially, yes. Lyocon is the booster. Techne is the orbit insertion.
A precarious position. If the booster fails, the whole thing crashes.
It is. But that's why the stock is 17 cents and not $2. The market is pricing in that risk.
It's time for the verdict. We've looked at the pivot, the cash, the charts, and the massive risks. Where do you land on Nuburu?
I'm giving it a bullish score of 7.5 out of 10.
It's surprisingly high, given what we just discussed. An 8-person team trying to conquer the world.
It is high, but you have to look at the risk-reward ratio. This is a classic high-risk, high-reward turnaround.
So walk us through the final thesis.
Nuburu has successfully transitioned. They are no longer a science project. They are an operational revenue-generating platform. At a $55 million market cap, the market is pricing in failure. If they succeed, even partially, the re-rating will be massive.
So you think the market is just lagging reality?
I do. The market sees a penny stock with bad history. It hasn't fully priced in the acquisition that closed today or the validity of the defense contract. It's looking in the rearview mirror.
Give us the price targets. If you're right, where does this go?
Near term, next 6 months, I'm looking for 35 to 50 cents. That's just driven by recognizing Lyocon's revenue.
That's a double from here.
Easily. Medium term, 12 months out, if the Techne defense revenue starts to flow, we could see 75 cents to $1.25.
It's long term.
If they get control of Techne and the SaaS platform scales, $2 plus. That's a 10-bagger.
But that assumes everything goes perfectly right.
It assumes they execute. And that is the gamble.
So what's the strategy for someone listening who might be interested?
You don't chase it on a spike. You accumulate on pullbacks. Look for that support level near 12 or 13 cents. If you can get in there, your downside is limited. This is a hold for 12 to 24 months if you give it time to work.
Definitely not a trade for the faint of heart. You are betting on a massive pivot with a very tight timeline.
But if they pull it off, you're buying a global defense contractor for the price of a gumball.
That's the data.
That's the potential.
Don't forget to subscribe, like, and comment. See you next time.